Wholesale prices rising in August, about in line with expectations. That's a final inflation data point as the Federal Reserve gets set to lower interest rates potentially next week. The debate on Wall Street continuing ahead of that meeting, with strategists mixed on whether or not the Fed would move to aggressively enough. Let's take a listen.
And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk.
I think a 50 basis point cut would reek of panic, and it's almost like we're totally behind the curve at this point.
The Fed funds futures are right. The chances are is that it's going to be a 25 basis point cut.
So let's get another voice to weigh in on this debate. We want to bring in George Seay. He's Annandale Capital founder and chairman, joining us now. George, it's great to see you. So, of course, this debate has been 25 or 50, whether or not if the Fed does go 50, is that going to incite some panic within the market, just about maybe ultimately what that tells us about the state of the economy? What do you think?
Hey, Shauna. Well, they should go 50, but they're not. They'll go 25 because they're very cautious and they're very much incremental in the way they go about things, but they're behind the curve at this point. The economy is slowing dramatically, and we need a significant rate cut, but it's going to be incremental. It's going to be over time, and it's going to be 25 basis points at a time. So it's going to be slow and steady. That's the way the Fed does business.
George, what is it more specifically that's worrying you so much? Is it some of that softness within the labor market, or what other data points are you watching that has you really thinking that the Fed should go 50?
We've had about a 15-year upsurge in the stock market and the economy, and the Fed had a historically strong rise in interest rates the last 2 years or so, and they've been very slow to unwind that. And I think that the economy is going to keel over at some point in the next 2 years, and I think the Fed's going to be too slow in how they combat it. But that's the way they're going to fight it. They're going to be very slow because they're very cautious. So I think they're behind the curve, just like they were behind the curve on inflation and slow to raise rates when inflation rose so much. And now I think they're behind the curve in cutting it back.
So how do you position for that potential, not the most optimistic potential reality, George?
I think you go into things that are sensitive to interest rates. I think people have been really negative on banks and financial companies the last several days in the markets, and I think they're going to really benefit dramatically when the Fed starts cutting dramatically, which they'll have to do over the next 6 to 18 months. So I would go into financial stocks and interest sensitive stocks and things of that sort. I would be hesitant to go into stocks that are really dependent on significant growth in the economy and all that, because I think the economy is going to slow dramatically. So I would go into interest-sensitive stocks currently.
Okay, well, I got to ask, George, then what you think about the tech trade.
Yeah, I think the tech trade is long in the tooth. I think it's been going on a long time, and I think that you saw the violent move to the upside in NVIDIA yesterday after quite a bit of correction over the last week or two. And I think that people are fighting the trend, and the trend, I think, in tech is down. I think tech has had a long move, and I think it's not quite over yet, but I think it's pretty much over. And I would be really, really cautious on tech at this point.
George, when it comes to earnings have been stable. They've been holding up very, very well. When you take a look at the estimates here for the current quarter, we have seen a bit of a revision here to the downside. Does that worry you at all, or does that support maybe the point that you were just making, just in terms of that rotation out of tech and seeing opportunity elsewhere?
Yeah, I'm not too worried about it. I think the market's going to chop. I don't see any falling off the cliff or anything like that, but I think that it's going to get a lot harder going forward in the markets. I think that we've been spoiled by over 10% returns for quite a long time, and I think that's over. I think making over 10% is going to be really difficult, and you've got to be very sector specific in terms of trying to capture those kind of returns, and I think we've got to get used to lower returns. Subpar 10%, positive returns, but I think it gets harder from here on out for the next 5 years.